Once more, you are welcome to Reka's Forex Academy. This is part 3 of a series of lectures on foreign exchange trade made simple. In part 1, we saw the introduction to Forex. And in part 2, we started with chapter 1, Understanding Forex. In this part 3, we are going to continue with lectures on Understanding Forex. We are going to look at pips, then Forex as a zero-sum trade, followed by what influences the Forex trade, and we shall end up with the basics of Forex. What are pips? PIP. PIP stands for Price Interest Point, and it is a measure of movement in the market. Whether the movement is upward or downward, we all measure using pips. It's just the same as if we use kilograms in measuring weight, such that with different items, we can quantify the price by the weight of the items. The same thing here. When brokers offer the pip value, if a pip value is $1.5, for example, and you make a movement of 3 pips, it means you have gained 3 times 1.5, eventually $4.5. Now consider the current exchange rate in pips to 4 decimal places for Great British Pound versus US dollar. If the current exchange rate is 1.6852, then if we are told that the market has moved up by 3 pips, what does that mean? It means that we'll add 3 to the 4th decimal point, which is 2, to obtain 1.6855, because 3 plus 2 is 5. So now the new price will be 1.6855. The same thing applies to Euro JPY. If the exchange rate is 157.245, remember we said with all pairs involving the Japanese yen, we take to 2 decimal places. So we are going to add, if there is an upward movement of 3 pips, we're going to add 3 to the 2nd decimal place, which is 4, to obtain 7. Thus, the new price will be 157.27 if the movement in the market is upward. Another example, still involving Great British Pound versus US dollar. If the exchange rate is 1.6852 and we are told that it climbs to 1.6882, what then is the movement in pips? We are going to take 1.6882 minus 1.6852 to obtain 30. Now, if we are told that 1 pip pays at £10, eventually 30 pips will pay at 30 times 10, which is £300. That is exactly how you'll be using pips in calculating the profit you make in trade. So this is exactly how the market looks like. If this was the market price that we read at 1.6340, and eventually the market moves upward to a point 1.6647. Remember, we are reading this from the graduated edge to the right. That is where we get the prices. Now, if this movement upward occurred, then to have the number of pips, we just simply take the highest price, which is 1.6647, minus the lower price, which is 1.6340, to obtain 307 pips. Eventually, if the reverse was true, that is a market price of 0.6440 drops to 0.6200, we can measure the change in pips as 0.6440 minus 0.6200, and we obtain 240 pips movement downward. Exercise. If Great British Pound USD was 1.6820 yesterday and it has moved to 1.6890 today, and we place $1.5 per pip, how much have we gained? Eventually, I will not give you the answer, but this is how you go about it. The movement, you have to first determine if the movement is upward or downward. 1.6820 eventually is smaller than 1.6890. So the movement was upward. The difference between these two prices give you the change in movement, which is the pip. So how much have we gained? You take that difference and multiply by 1.5 to get the total gain in dollars. Another exercise, if Euro CAD is 1.4660 and we seek to make $30 when trading long. Trading long here will just mean when we are going up or when we are buying at $1 per pip. What is my target price? Here you just have to convert the amount you have, you divide it by the rate per pip. If it is $1 per pip and you seek to make $30, it means that you've made 30 pips, because $1 per pip and you made $30, it means 30 divided by 1 will give you the number of pips. So what will be the target price now if you are going up? If you now realize that there was a movement of 30 pips, you just need to add it to 1.4660, which means you are adding 30 to the last two digits. You have now 1.4690. Eventually, this is how the market presents itself. When we have prepared the market this way, you will see what we call candles. The Japanese do trade using candles. The green candles are the bull candles, always trying to move up, while the red candles are the bear candles, always forging down. So all you have to do in Forex throughout the number of years or days you will make in the trade is monitoring the movement of these candles. Remember, it may turn green and you think that is going to go up, and eventually turns red and moves down, leaving a tail. So that is eventually what you'll be doing in Forex. Now, whether we are trading upward or downward, we'll make profit in either direction. When we are trading upward, we say we are going long or we are buying. And when we are trading downward, we say we are going short or we are selling. In either direction, we aim at making profit. Forex as a zero-sum trade. This means that all what we invest in Forex comes back to us and part to the brokers. We are going to see in the next chapter or next part of this series that all the monies we contribute and put in the market, we share between us and the brokers. The brokers ask from us what we call the spread, which is the amount we pay for keeping trade within their MT4 platform. So if I'm winning, for example, it means that somebody somewhere is losing. If I'm winning while buying, somebody somewhere is losing while selling, and vice versa. What influences then the forex trade? The forex trade has a lot of influence. When you are in the market, you may see the market at times moving very slowly and at times very fast. The slowness and the fastness of the market are influenced by several factors. It might just be the algorithm, which underlines the application or software we are using, or maybe as a result of trade balances between countries. If you are trading currencies pairs, for example, or as a result of the interest rates offered by the banks of the currency pair the countries of the currency pair you are trading. Let's now look at understanding the basics in Forex. Most often than not, you will need to come back to this chapter when you are treating chapter 3 and chapter 4. Chapter 3 will be basically on understanding the MT4 platform, and chapter 4 will be on trade analysis. It is at that time that most of these jargons you have studied in chapter 1 will repeat themselves, and you will need to come back and revise in order to understand what is taking place. Developing a trading system. What then is a trading system? A trading system is simply a group of specific rules or parameters that determine entry and exit points for your trade. These points, known as signals, are often marked on a chart in real time and will prompt you to pull the trigger. The trigger here is either placing a buy order or a sell order. At the end of the lesson, we will be able to come out with what we call a trade plan. A trade plan is very important and saves the trader as the constitution of a state. So if you respect your trade plan, you will be in peace. Just like any state that respects the constitution, always it remains in peace and is stable. Here are some tools that we're going to use in able to monitor the trends and follow up our market. We are going to look at these technical tools in chapter 4, but it is better to point out some of these tools. Out of thousands, I can talk of chart patterns, moving averages, stochastic oscillators, Kahilo activator, Bollinger Bands, alligators, parabolic SAL, and so on. We'll come to this when we are doing trade analysis. So those are the tools that are embedded into your MetaTrader 4, and they can be very useful for you in monitoring the market movement. The Euro USD and some other 6 measures moves on an average 100 pips a day, and the movement, as we know, could be upward or downward. While the Japanese yen is different. In the Japanese yen, a pip, as we have seen, is denoted by 2 decimal places. For example, if the current price of USD JPY is 158.58 and there is a movement of 3 pips upward, it means that the new market price will be 158.58 plus 3. You find out that 3 plus 8 is 11, 1, and carry 1, you add 1 to the 5, it becomes 6. So the new market price now will be 158.61. In a typical currency quote in Forex, currencies are quoted and traded in pairs. A typical trade screen has important information that reaches everyone at the same point, which means that wherever you are on planet, you have the same market. Your market may be slow or faster depending on the internet connection you have. And what makes this movement we see are macroeconomic data, for example, employment data, unemployment data, GDP, interest rates, inflation rates, and so on. Those are the parameters used by banks in making the trades move upward and downward. And this is what we are saying. We have earlier seen this chart. So there is an upward movement here, and incidentally it starts moving downward. What may cause this jump that we refer to as breakout could just be a speech made by a governor of a central bank in Tokyo, for example, if you are talking about Japanese yen, and that may affect traders' view of the Japanese yen. So the Japanese yen may become stronger because it is always a quote currency. We're going to see that when the quote currency is stronger than the base currency, the market trend reverses downward. And when the base currency is stronger than the quote currency, we expect an upward trend. It is easier to monitor information in the currency market than the stock market, where I know it is left to each and everyone to be able to say which one is better. Is it the currency market, or the stock, or the cryptocurrency, or the bonds, or the commodity market? For me, it is your experience in it that matters. I think I always prefer to tell people that of the over 800 markets, we refer to them as assets. You cannot trade all. One asset alone can make you rich. So you just need to determine which asset is best to you, you understand it well, and then you put up your technical tools to monitor the market, and you also follow some economic news. The bull and the bear market. As I've earlier said, the bull market will be shooting upward while the bear market will be shooting downward. And this happens when there is a recession in the economy. You will read this after we must have finished with chapter 4 to be able to understand better. How do we read Forex quotes? Currencies are always quoted in pairs. Great British Pound, USD, JPY, Canadian dollar, JPY, and so on. The reason they are quoted in pairs is because every foreign exchange transaction, you are simultaneously buying one currency and selling another. So, if they are not in pairs, it will mean that you are not buying or selling any of the currencies. Consider, for example, Great British Pound versus USD. If the current price is 1.51258, we refer to the Great British Pound as the base currency and the USD as the quote currency. Well, we have said this over and over. The first currency is the base currency and the second is the quote currency. I will allow you to read this to the end, and maybe we'll come back to this when we are in chapter 4, when we shall really be applying some of these terminologies in analyzing the market. Here we are still talking about when you observe a change in the movement upward, you know the base currency is becoming stronger than the quote currency. And when you experience a downward movement, it means that the base currency is becoming weaker than the quote currency. We've come to the end of this lecture.